things you should know about the economy. This episode was recorded on 23rd of September 2011. It's based on my independent view. Today I'll explain why the US dollar will rise strongly in the next 12 months. First, I'll show you a chart on dollar's role as the world's currency. Second, I'll discuss what's driving the value of the dollar. Third, I'll show you whether the US dollar credit has been expanding or declining since quantitative easing had begun. I'll wrap it all up with a summary, then finally show you why the timing is right for the dollar rally. Before we begin, let's clarify, what is currency? Currency is something that's used as a medium of exchange. It's widely accepted without questions. This exchange function of the dollar is at least as important as its function as a store of wealth. Remember this fact, because we will come back to it. Now, let's begin with the following slide. This is the single most important slide of the entire presentation. The chart shows that the biggest portion of the world's currency transactions involve the US dollar every single day. Transactions in the US dollars exceed those of Japanese yen, British pound, Swiss franc, and Canadian dollar combined. When transactions in euro decline because of the European debt crisis, which currency do you think will benefit by absorbing that demand for transactions? Now, will the dollar be loved all of a sudden? Of course not. The dollar will rise out of necessity because there is no alternative to it yet as the world's medium of exchange. In other words, despite the fact that the dollar is a worthless piece of paper backed by nothing, half the world use it to purchase goods or settle their debts. In times of crisis, investors, banks, and consumers scramble to find dollars to repay their debt or obtain funding. European banks are already struggling to get dollar funding from money markets, and they lost access to more than $700 billion since last year. Because of that, on 15th of September, European Central Bank had to arrange US dollar funding for these banks. These European banks have lent dollars to many corporations, and they need dollars to maintain their lending commitments. Euro, which was supposedly an alternative to the dollar, is politically vulnerable. When Greece finally defaults, a lot of European banks will be in trouble, and corporations will rush to obtain bank borrowing from outside the Eurozone. And whether they go to US, Middle East, or China, which currency do you think they will want their funding in? Recently, one big corporation approached Citigroup asking for $1 billion US credit line to replace the European bank. But why am I saying that dollar will rise, but not other currencies? How about Swiss franc, sterling? Wouldn't they rise for the same reasons? The reason dollar will rise much more is that, ironically, more credit is denominated in dollars than any other currency. This includes $10 trillion mortgage-backed securities, derivatives, credit margins used by funds, and US Treasury bonds. In good times, there is little perceived difference between risky assets and dollar notes or equivalents. However, in bad times, that difference begins to materialize. In other words, as bad credit dollars or IOUs disappear, the value of the remaining good dollars rises. Okay, now we know about the payment function of the dollar. What about its global role in storing wealth? Take a look at the following chart. The chart shows you that the proportion of the reserves denominated in US dollars to the total reserves in the world has been declining since 1999. But even with that, the entire world still keeps and claims 2/3 of all its reserves in US dollars. It's still so significant that no other currency compares to it. Countries like China keep their most reserves in US Treasury bonds that are denominated and therefore purchased with the US dollar. Holders of these reserves treat US government bonds as cash, because they're highly liquid and can be easily exchanged for dollars. Okay, so treasury bonds and dollar notes are interchangeable. But what is the relationship between total US dollar debt and the dollar itself? See the next chart. This chart shows you a proxy for the total US dollar debt versus trade-weighted dollar index. Based on this chart, since 2002, debt issued has been driving the value of the dollar. US economy grew more slowly in 2000s than in 1990s. Now, when the economy is weak, the bigger the net debt volume, i.e. the credit issued, the lower the value of the dollar. The opposite is also true. For example, total US dollar debt declined for the first time in 2008. And the dollar rose during that period significantly. So right now, the value of the dollar depends whether new credit can be issued faster than the old debt declines. Now, we already know that US government has begun to tighten its borrowing. And in addition, banks and corporations and even households are cutting their debt via asset sales, reduced borrowing, repayment, or just default. But what about the Federal Reserve, who has supposedly expanded the monetary base since 2008 by purchasing $3 trillion in government bonds, mortgage-backed securities, and foreign debt? Didn't that flood the market with new credit dollars? See the following chart. The chart shows you the money multiplier ratio from 1984 till present. The money multiplier ratio is the ratio of M1, that represents total on-demand dollar deposits held at banks, to the monetary base, which is cash notes plus bank deposits held as reserves at the Fed. As you can see, the money multiplier has gone below the ratio of 1 and got stuck there, despite the $3 trillion expansion of the monetary base. This means that the dollar credit not only failed to multiply, but in fact has declined since it was issued. And the reason the new money failed to multiply is that people simply don't want to lend or borrow. Besides, now the political will to inflate is turning into an aspiration to deflate by budget austerity measures or even hostility of legislators towards the easy monetary policy. This may be a good example against the argument that fiat money has always got to move somewhere. Few people realize that credit money can disappear just like it came from nowhere. And all of this strengthens the case that the dollar will appreciate strongly in the coming month. Okay, let's sum it all up on the following slide. Yes, it's a very shaky pyramid. On the very top, we have the most risky dollar IOUs that can disappear overnight, such as mortgage-backed securities and derivatives. Oops. Another group is money market funds, bonds, and even equities. None of this can be exchanged to cash values without affecting their market values. Now, the safest dollars are simply cash notes, such as $100 bills and very short-term US Treasury bonds. As this pyramid shrinks, the purchasing power of the remaining units of dollars should increase in value relative to financial or even physical assets. But how do we know when the dollar begins to rise? One of the signals come from sentiment measures, as shown in the next slide. In April and May of this year, daily sentiment index recorded just 4% bulls on a weekly basis, which was the lowest reading since March 2008, just before the dollar rose by 20%. We all have come to hate the dollar so much that predicting its collapse kind of became popular now. After a long downtrend in the value of the dollar, there have been published many academic articles or even books arguing that the dollar will not survive or will be devalued. Of course, all fiat currencies, all currencies in general fail at some point. But the question is when. So, the time will tell. Until then, the dollar should remain the world's currency. In the next series, I will discuss how the European debt crisis is likely to play out in the next 12 months. Stay tuned.